Before we dive into this video, there's been a lot of talk in the US media about DOGE and its effects on the US economy right now, and I want to make this completely clear. This is not a political post. This is purely informative to understand how DOGE could have an impact on mortgage rates in the future. So the primary goal of DOGE is to reduce the US spend, the amount of money it is outlaying on different departments and services and things like that. And because it reduces spend, that would increase its ability to pay loans. Because that money is not going to services they don't deem to be necessary or needed anymore, it therefore increases your ability to pay your loans. And then that therefore reduces your perceived risk of default on these loans. It's no secret, America owes a lot of money to a lot of countries, and by increasing the ability to pay back those loans by reducing spend, you reduce your risk of default on them. Now, because the US has a perceived rate of defaulting on loans to be decreased, it means also the rate they'll be charged on any future loans that they request from other countries will be reduced too. Now, because their loan repayments have decreased, because their interest rates have decreased here, that means they don't need to raise as much money via treasury bonds in order to repay these loans, since the rate has gone down. And we know that this number is the most important factor that is tied to mortgage rates. So if the treasury rates go down, that should mean in theory mortgage rates go down. And we're seeing this right now. The Fed is cutting rates, but this is not budging. Therefore, this is not budging. So if all of these things align, in theory, mortgage rates should decrease. Added bonus of all of this too. If US government spending cools, that also means inflation would cool, which also would be a huge benefit for mortgage rates and help make home affordability a lot better for those looking to purchase a home.